Hello, everybody. Good afternoon. The Fed has spoken, and markets definitely are not liking what they had to say. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, data, trends we're watching, and hopefully weed out some of the noise along the way. And of course, here we are after a Fed meeting, which again did not disappoint or did disappoint. A very good example of how we try and help weed out some of this noise here for everything going on lately and how much it revolves around the Fed. So most of our conversation today, as you might imagine, is going to be based around inflation and the Fed. But we'll also touch on some of the jobs data and what's to come next week ahead of kind of more of a typically slower week with the holidays and all that good stuff. So basically, let's start out late last week where producer prices came in. Producer prices came in on Friday, actually much higher than expected. So this is really interesting. It was, a kind of a sign that the Fed was likely to, be aggressive and kind of continue this hawkish tone. But then fast forward to Tuesday, right before the Fed meeting, and we had CPI data come out, consumer price data come out. So core CPI was up 0.2% for the month versus expectations at 0.3%. And we saw a huge rally. So that morning, Tuesday morning, markets were up something like 2%, depending on which index you were looking at, 2% early on in the markets. And very quickly through the course of the day, all of those gains kind of dwindled through the course of Tuesday there. And then, what's important to note is even as you're looking at that, what the market obviously took was that this meant the Fed may not be as aggressive. But the year over year inflation data, remember, all this meant was it moved from 6.1 expectation to 6. So, it's not like this was a huge data point, like this totally changed everything we were looking at. But there we see the markets and the speculation around what may happen. And again, it was a huge takeoff. And then I think over time, maybe the excitement dwindled a bit and we saw the market pull back ahead of the Fed meeting on Wednesday. So the main event, of course, and what we're going to spend most of our time on today was what the Fed had shared on their Wednesday press conference, I should say. I'm sorry. So probably to no surprise, we've talked about this time and time again. What the Fed did is they hiked 50 basis points for this meeting. But I thought maybe what was most important, we've talked about this 50 basis point hike for a while. I think the Fed has been very clear that that's where they were going to go. They've projected that time and time again, reinforced it time and time again. So, I don't think it was much of a surprise. But what was interesting is that 17 of the 19 Fed chair members all believe that the neutral rate is somewhere close to about 5.1% target. So that's still another 75 basis points, 0.75% that the Fed needs to increase before we get there. They kept saying that we have more work to do. We have more work to do. We have more work to do. And they've said that time and time again, but I thought this one was really interesting at a time where, again, I think with the market swings we've seen over the last month or two, a lot of people were expecting, I think, the Fed to pull back a bit. And I think it's very clear that they're still not, right? So that's where we're at, 50 basis points. Again, a huge majority of the Fed members are believing that we need to go another 75 basis points to get to a neutral rate. But of course, they will continue to assess as the data comes out, right? All right. So what I thought was interesting in the midst of all this as well is that one of the things that the Fed had shared also was that they expect, obviously, this year to be a higher inflation rate, but moving into 2023, they still expect a 5% inflation rate over next year. So clearly, this whole take on this inflation issue being transitory is completely out the window. Fed basically shared that this year is going to be high, 2023 is going to be maybe a little bit lower, but somewhere around 5%. And then I think they said 2024, they still expect around 3% or so. So it's going to be a 3-year process till they get to their target 2% inflation rate. What was really interesting, let me switch gears here a little bit and I'll try and I'll share the positive side, I think, of what came out as far as the markets go too. What I did hear is that he mentioned that speed was not as important anymore. So in other words, these giant rate hikes we've done this year, I mean, we've gone 4.25% over 9 months. these giant rate hikes that we've done this year, what he had shared is that that was important to get a quick jump start on this inflation issue and not let it get out of control. What he did share is that from here, he doesn't feel like speed is as important. And in fact, really hinted quite a bit at the idea that moving forward, they may drop to more like 25 basis point hikes. So not to be negative Nancy here all the time. I think that, if I'm going to find some positivity out of this, that is it. But remember that the Fed doesn't talk again until February. So we've still got a lot of time to go. There's a lot of data between now and then. So it's really hard to get too wrapped up into these meetings, especially when they're more spread out like this, because we will still get a lot of data ahead of then. And again, I think the Fed will pivot based on what comes out of that. So what we're going to watch really closely is the January inflation data. That will start to tell a bit of a story as far as what they may do in February. But it sounds like you can pretty much feel confident in the fact that they will hike. It's just whether or not they do 25 or 50 basis points come that February meeting. What was also interesting is that they said that there is no cuts in 2023 likely. So as they get to this target rate, let's call it 5.1, we'll see where we go with that. That even when they get there, they don't plan to cut them for a long time. So there's been this conversation about cutting rates in 2023. I think they all but took that off the table. Now, if there's a really bad recession or something along those lines, I imagine that they may do something like that to try and reduce that impact. But they basically said, all of next year that they do not plan to cut rates. And so I think that's why here we are on Thursday seeing a big drop in the markets is based on the reaction around that piece specifically, but also that I think the Fed is going to continue to be hawkish, in other words, aggressive with their rate hikes for maybe longer than a lot of people had expected going into this. All right. Last thing I'll touch on here is that what I thought was really important, I touched on this actually last week in our Thursday update as well. There was some data that came out that suggested that inflation was switching a bit from the goods side of the economy to the services. And the Fed actually pointed that out. So I think that's why they're continuing to be aggressive here. They're seeing exactly what we were, and they're saying, okay, although inflation may be coming down a little bit on some of the goods, doesn't mean the prices are coming down, but the rate of inflation is. The services are now picking up for that difference. And so we're starting to see more widespread inflation, which is a big challenge. And quite honestly, I think that maybe we're still being a little too positive on this inflation story. We've talked about this from time and time again, that we don't expect it to go away anytime soon. I think now the Fed is saying the same. But even so, I think that there's a little maybe too much confidence in the fact that what they're doing is going to handle it. So time will tell. We'll see. But that's kind of where we're at. The big takeaway is the Fed's going to keep pushing, and inflation is a big issue, and they're going to act on that. So again, it's amazing to see the market swings just based on what they say and the data that comes out in the meantime. But let's keep in mind for us longer term investors that the Fed has been very clear on their path. So it's easy to get wrapped up in one data point, but the Fed is not doing that. So it's more important, I think, to listen to what they're sharing, to, especially again for longer term investors, to understand what that really looks like, and not get too wrapped up in these swings from week to week, month to month, that just seem entirely based on a range and entirely based on what the Fed may or may not do. I think once we know that they're getting close to a point of ending these rate hikes, that's where maybe we start to see some opportunities really moving forward. So keep a close eye on that. We'll obviously continue to keep you posted, but that's where things stand. Coming up next week, we have a lot of housing data and consumer confidence. So we'll share that. But again, to keep in mind, the last 2 weeks of the year are typically a bit of a slower time as the holidays get closer and closer. We will skip the question of the week this week because we had so much to cover on the Fed, but we'll be back next week with a question, and we look forward to seeing you next Thursday at 3. Enjoy the ramping up holiday season, and we'll see you next Thursday.